with the Inflation Reduction Act, they were talking about a lot of credits, but R&D credits have been around forever.
They have. They've been around since 1982.
Right. And so most people think of R&D as research and development. That's what I think, but it's a lot more than that, isn't it?
It is. So when it first was enacted, it was for your bigger companies to keep technical jobs here, but it has changed so much over the decades, and so it's become more of a sort of like an employee retention credit. If you have people that are performing certain functions, and there's kind of a dovetail here, it's keeping your good technical employees in the U.S. employed and working and inventing and improving things. But it's not your basic research. It's not like your college laboratory, funded research thing. It's the applied research perspective there. Meaning, at a business, you're going to have technologies that have advanced because of university research or the bigger companies or whatever. And so what you're doing is you're saying, how can I apply those advances in technology to help my business? So it's that applied research that can qualify. And that hasn't always been the case. That changed around 2000, 2001.
What is applied research again?
So applied research is the application of advancements in technology to a specific purpose.
So the company doesn't necessarily create, or they don't do the R&D themselves, but they take somebody else's research and development and they apply it to their industry and they make use of it. There's utility. That's the credit.
I'm going to nitpick
go ahead, please do.
The actual language. So the companies are still doing research and development. They're still experimenting with how to implement the new technologies, or if there's multiple technologies, which one is going to work best, or is this technology even going to function adequately or appropriately to my business? So there's still uncertainties, and they still have to run through experimentation or testing, trial and error, to see if they can get it to work. So they are still experimenting. But again, it's not they're not uncovering things that are going to be new to the world or their industry per se. It's saying, okay, advances have been made. How can I adapt my business to take on those advancements and improve what I'm delivering to my customers, or reduce lead times or whatever?
So give me an example of
I figured that was the next step. So automation in manufacturing,
Okay.
right? So people will make these robots that do multi-axis welding or whatever, right? So there's arms that come in and whatever. So if a lower tech manufacturer or job shop has never done that before, well, they can say, all right, I want to be able to produce better or more welds in a given unit of time than having a team of people do it. And so what they'll do is they'll say, okay, I'm going to research the different welding robot technologies out there. I'm going to bring a couple of them in, try them out, or just bring one in, and then I have to program it and go through iterations of like using the right materials, using the right programming to make this work, setting it up in my production line to make sure that it's in the right spot so that I don't create issues on the manufacturing floor with bottlenecks for production and things of that nature. And so that iterative process of going through to figure out, how are we going to get this technology in place and make it work to improve our manufacturing process? That's qualified R&D.
Okay, so the money I spend as a company on trying this out to make it part of my process, all those costs now, that's what the credit is for?
Yes. Yes.
Okay.
So the credit is calculated based on an aggregate of all of the wages, material supply costs that are consumed during the testing, the outside contractors that come in to help, especially if you're doing outside programming or what have you, as long as they're in the U.S. And then for software developers, if you are using the cloud storage as your sandbox for application development, then those cloud computing costs can also be aggregated into that total of qualified research expenditures, and that's what you use to calculate your credit.
Okay, so you mentioned manufacturing. That makes a lot of sense, right? What other industries are benefiting from these R&D credits?
So, like you said, any manufacturing, and it's not just the manufacturers that are making their own product. It's not like the folks that are saying, okay, I have a product idea, I'm going to start mass producing my product, and I got to test it to make sure it works, et cetera. You also have the job shops, the contract manufacturers as well. Then they're not making their own products. They are finding ways to mass produce somebody else's products. So they don't own the final product, but they are figuring out how to make 1,000 of them reliably or whatever. Outside of manufacturing, you've got any kind of a software company. And actually, your software companies are, of course, going to be developing software, but where we've also seen this take off is companies that normally wouldn't qualify, like retail establishments. If they hire somebody to come in and create sort of a point of sale system, then that may qualify. So any software development activity is likely to qualify. You've also got engineers and architects who are going through these same iterative design processes to design buildings or components of buildings or other structures. And so that is a good ripe industry for this as well.
Okay, so let's get into the specifics a little bit. So these companies that are solving these problems, how do they qualify for the credit?
All right, so the credit qualification is based on a four-part test. And that four-part test, if you want to go and Google it, it's everybody talks about it, but it's not verbatim in the statute. It's derived from Section 41.
Now you're going lawyer speak now.
So if you go into the Internal Revenue Code and search in LexisNexis or whatever four-part test, that language in the Internal Revenue Code or the Treasury regulations does not exist. There's a section in the Internal Revenue Code, that subsection of 41, that tells you, okay, what is qualified research? Because if you have qualified research and then you have the qualified expenditures that you're using to make that research happen, then you have a potential credit. So for qualified research, what the four-part test boils down to is, are you developing a new or improved business component? And a business component is a product, a process, a formulation, invention, technique, or software, okay? And you meet that test if your new or improved business component is being developed for the permitted purposes of functionality, performance, or
quality,
reliability. Yeah. So quality. So those are the if you meet that test, then you qualify. So you can see for manufacturing, for example, if you're developing a manufacturing process to mass produce like headlight covers for a Tesla, right? You're doing plastic injection molding most likely, and you have the specifications that some engineer at Tesla designed, but now it's like, okay, I've got to find the right resin, or maybe that's specified, but now I have to create a mold to push this stuff into, and I have to be able to do it reliably so where there's no issues. And so I have to make one of them or 10 of them and have them make sure that it's okay. And then once I've done that, then I can mass produce hundreds of thousands of them or what have you. So that process, and Tesla may not use this because it's so new, but the production part approval process, PPAP, is the process that most automotive manufacturers use. And it is a step-by-step process to make sure that you have all the tools in place and organized correctly and set up correctly to make these parts to specification. And that, of course, you're developing a manufacturing process for the quality purpose as well as quality or reliability, but there's also the functional aspect of what have you. But that meets the first part of that first part test. The second test, and these are all and tests. If you just meet one, it doesn't qualify. You have to meet all four. Second test, is there any technical uncertainty with what you're doing? A technical uncertainty is, are you uncertain of the capability, methodology, or the final design? So with the manufacturing process, you may not know at the outset what the rate of plastic injection or the temperature needs to be in order to make this headlight to where it's clear and doesn't have any manufacturing defects or whatever. Or it could be you've got different mold designs that you can use, and so you have to choose the right one. Or, of course, what is the final manufacturing process design? What are the steps need to be? And so if you have those types of uncertainties, then you meet the second part. The third test is, do you undertake a systematic approach to overcome the uncertainties? And it's called the process of experimentation test. And it is. But the reason why I put that in air quotes is it doesn't have to be the scientific method. It can literally be just you list out the things that you need to try to make sure this is going to work, and you go through them systematically and hopefully are documenting what's working and what's not and why. And if you're using that systematic approach to overcome the uncertainties, then you meet that process of experimentation test. The fourth and final test is, does that experimentation, that systematic approach, rely upon one or more of the hard sciences? Well, for software development, which we've talked about, then computer science is a hard science. Engineering is a hard science. The life sciences, biology, chemistry is a hard science, physics is a hard science. So engineering, computer science, physics, chemistry, biology, those are all hard sciences. And if you're a manufacturer, then your hard science is basically going to be either physics or engineering, potentially chemistry if it's plastics and you're worried about different resins or whatever. So if you're evaluating success or failure during your sort of systematic approach to overcoming uncertainties, and you're leveraging or using or relying upon one or more of those sciences, then you meet that test. So it sounds really complex and complicated, and it kind of is. It doesn't seem that way to me most of the time,
right.
but again, if you're in business and you're saying, okay, I think I might qualify, let me go look up some stuff about this. There are, again, the statute is pretty complex, and it references not just Section 41, but it's also 174 and some other sections as well, the way that the law works. But there's also court cases and IRS guidance and all these things out there that really, and the IRS keeps kind of moving the goalposts too and saying, okay, if you're going to amend a return now, you've got to do these more things. And they've just put out an announcement saying, hey, starting in 2023, we're going to include additional items that you have to include when you file and things like that are just more and more onerous to make these claims, which is good for business because it makes it more complex, and it's, we take that on, and it's not anything new that we have to do. We already do that work, but now we have to do most of it on the front end before we can have our clients file.
Okay.
I've kind of digressed a bit, but basically, if you meet that 4-part test, then you qualify. And our job is, it is kind of complex, but our job is to come in and say, okay, let's document using what resources you currently, what documentation you already use to prove this out, and then we'll back it up and explain what's going on in these documents. And then behind that, we do all the calculations and do all the support and what have you.
But sorry, Jack, I know where you're going to go with this. I have the same questions about compliance.
Yeah.
But before we get to asking the questions about compliance, let's get a little bit better understanding of how the credit is applied first, and then we'll come back.
That's what I was going to ask.
Okay.
So you get this. Let's say everything is up and you have everything in order. How does this benefit your client's bottom line?
Is this a income credit? Is this a payroll tax credit? How's this applied?
So the short answer is yes. For most companies, it is an income tax credit. So if you're not paying any federal income tax, either and it does pass through. So if you're a C corporation, the C corporation's paying the 21% tax rate for now, and then this can offset the taxes from that income. If you're an S corporation or a partnership and the income's flowing through, then the credit flows through the partners as well. And then we worry about, are you indeed paying tax? And most likely, hopefully you are, but are you paying the alternative minimum tax and all those kind of things? So, but it is an income tax offset. And so there's kind of a decision tree that we have to go through to see how much it will benefit you. You may generate $1 million in tax credits, but if you're only paying $100,000 in tax, it's not going to do you as much good as that $1 million. So your eyes may be bigger than your stomach at that point. Good news is it does carry back and carry forward. Carries back 1 year, carries forward for 20. But that's one of those situations where this can be complex. So if you generate that much credit and you can't use all of it, then we can work with you on a number of ways to figure out, okay, what makes the most sense.
Now, usually you get a deduction for business expenditures, right? Just generally speaking. So is this on top of or in lieu of a deduction, or do you get to kind of take 2 bites at the apple here on these?
So it is a little more complex than that. So the way it works is you do have deductions for most of your business expenses under Section 162. So any business expense you have, you're able to deduct, and there's some limitations on some things. Right. For the longest time, and I think ever since the 70s, you've had a separate code section, 174, that said that you can choose to elect to expense or amortize R&D expenditures. Mm-hmm. Okay? The Tax Cuts and Jobs, and so before I talk about that change, so when the R&D credit came to be, what they said was, all right, if you're taking a credit, then you have to reduce those R&D expenditures, those expenses, those deductions by the amount of your credit, so that it's so you're not double dipping. Yeah. So if you have $1 million in R&D expenditures, your credit's not $1 million. It's not 1-to-1. Your credit is calculated from those expenditures. So you get maybe maximum 10%. Okay. So then 10% of those deductions you now have to back out. But your credit, that $100,000 in credit, and now $900,000 of deductions, your credit saves you more tax than that $100,000 of deductions because the tax rate. The tax credit is a 1-to-1 reduction of your
liabilities.
Tax.
Yeah. Credits are always worth more than deductions.
Exactly. I do want to talk about the change to 174, but before that, the other answer to your question, when I said yes, is it a payroll tax credit or is it an income tax credit? The PATH Act from 2017, or 2015 rather, that went into effect in 2016, changed the R&D tax credit to where not only can it offset AMT permanently, and it made the R&D tax credit permanent, it made the AMT offset for certain smaller companies permanent, and it also made it created a provision in which startup companies can elect to, instead of claiming an income tax credit, claim a payroll tax credit. And those payroll tax credits are available for 5 years, and it's consecutive years. Once you claim it, your window starts. And they tapped out originally at $250,000 per year, and now it's $500,000. And they carry forward indefinitely until you use them. So startups in the past, most startups, you're starting to invest in whatever technology you're developing to create your business, but you're not paying any tax because what you've invested in and all the expenses are more than the money you're making up front, and so you have these losses that you accrue. So this payroll tax credit provision for startups is huge. We've had a lot of companies. We've worked with dozens and dozens of companies that have started up. Some of them have unfortunately failed, not many, but some of them are growing, and we see like we're ride or die with them because we helped them with those payroll tax credits, and now it's like we're figuring out the timing for those income tax credits. So anyway, so again, for startup companies, payroll tax credits; for non-startups, and income tax credits. Pivot back over to the question about the expensing. The Tax Cuts and Jobs Act changed, so effective this year, 2022. So for your returns that are going to be filed next year in 2023. For tax year 2022, you no longer have the option to expense R&D expenditures. This is across the board for everybody.
Okay.
So even if you've never claimed the R&D tax credit and you're like a software developer, something that's obviously R&D should be claiming the credit, your deductions are going to be reduced for those software development expenditures or any other R&D expenditures by 80%. You have to amortize them over a 5-year period unless they fix it. And hopefully, fingers crossed, they will before year end. But basically now, so starting now, the R&D tax credit is so much more important because you're losing a chunk of your deductions right now.
Yeah.
It's not great. And again, there's been several things that they've tried. It was supposed to be part of the Inflation Reduction Act, but they got it out of all the wrangling, politics, whatever. But hopefully, whatever they're doing now is going to push this through because we need this. Like, it's not good for companies, all these companies across the U.S. that are doing good R&D, developing technologies, strengthening their businesses, to now lose 80% of their deductions because they have to amortize it over 5 years. It hits now, and you start to break even by claiming the credit after about 5 or 6 years, but it's not a great situation.
So you're talking about tax year 2022.
Correct.
So this year.
Right.
Okay. So
and if so, we put in our company email signatures a note about how, hey, this is going to change. If your CPA has any questions, let us know. It's probably not the best way to do that because we had one person ask. It's a big deal. And if CPAs are not aware of it and they're not already on the books showing that these expenditures are R&D expenditures and have to be amortized, and so from a bookkeeping side of things, as year end approaches and for estimated tax purposes throughout the year, it's going to suck for a lot of people once they know what their tax bill is going to wind up being for this year.
Yeah. So let's go back to I want to switch back to compliance here because this sounds all great, right? Everybody loves tax credits, and you mentioned earlier on the Employee Retention Act, Employee Retention Credit, and I can't tell you how many phone calls I get, emails, spam I get talking about the $26,000 that I may be eligible for, whatever, and I'm like, oh, I've had enough of this, and I know the government's cracking down on it. There's a lot of shops that popped up. And a lot, aggressive promoters and not good. And so I want to make sure we separate what you're doing from all these phone calls people are getting with the employee retention, the employee retention credit.
That.
So first, can we touch a little bit about the employee retention credit, what that is?
Yeah. So during the pandemic, the government started to push out these different tax credits and incentives and funding for businesses, especially small businesses, because it was hard and there's a lot of uncertainty. And so to try and calm the market down and whatever, it's okay, what can we do to help out? There was your EIDL loans, economic something, I forget what it was. And you had to pay that back. The PPP loans, which you didn't have to pay back if you met all the requirements. The PPP loans, I think we found out now, were abused, and they're going after the folks, which is, sad, but good that people will be held accountable. And then they came out with this employee retention tax credit. And it's good because if you kept your employees during an economic downturn, if your business suffered during the pandemic, then this is a reward for keeping your employees, and that's fantastic. The problem with how it was rolled out was that it changed several different times. So the guidance kept being updated. And so when people first saw it and were like, okay, I don't think I qualify, they discarded it and moved on. And the changes were actually better. At first, they said if you claim PPP, you can't also take advantage of the employee retention tax credit. Well, that's not true. What the law says now, and what the guidance says, is, hey, you cannot claim the employee retention credit for wages that were covered by the PPP loan. And if you got a PPP loan and you went and got forgiveness, you know that you specified what period of time, was covered. And so you may be qualified in quarters. That I think I answered your question, and I'm kind of going down a rabbit hole. So if you qualify in every quarter because your revenues dipped to the extent that it was 50% in 2020 and 20% in 2021, then you just pull out those quarters that were covered by PPP and you can claim the other quarters. But it's even more complex than that, because your PPP loan could have covered not just wages, but also other operating costs. Well, those operating costs aren't wages in the employee retention credit. It's just focused on wages and, of course, healthcare costs, the cost of insurance. And so the first thing that we always look at, and we have to work, we do ERC work, employee retention credit work, for some of our clients, and we're out there doing it. We don't advertise it like what you're seeing, because I just don't like advertising like that to begin with. It seems kind of sketchy to me. But we also have to look at it, because if you claimed the employee retention credit for dollars of wages, we can't include those wages for R&D purposes.
Right.
In 2021. And so we have to go through and figure out, okay, what did they claim? Is it a good claim? Is it actually viable? And it's a tough situation, because some people saw the money and they needed the help, and they went to these folks that were screaming about this, the calls and the emails and whatever that you're talking about, and they don't have a good claim.
Yeah.
And it's hard, because we have to go in and tell them, it's like, hey, this is not viable, but you have two choices. We can either just roll with it and use your numbers and back out of your R&D credit, or you can adjust your claim and take the hit, pay it in, or whatever. So
Les, how do business owners protect themselves when they're getting bombarded with this ERC phone calls and mail?
Yeah.
And Jack, I was at a symposium where one of your colleagues was talking about this specific thing, how the government's cracking down on this. But how does the average person who hears about this, how do they protect themselves?
So the answer I give to that question in all things is talk to your CPA. Like we get most of our business through CPA referrals, because they know that we're doing things above board and all that kind of good stuff. We handle audit defense if it ever gets looked at by the IRS or a state taxing authority. And so we don't qualify the things that don't qualify. Your CPA, if they don't think you qualify, most likely you don't. If they're telling you not to go after it, don't go after it. If they put you on the phone with somebody, they've likely vetted that person, and you're probably okay. The the other thing that I would say is there's two ways to qualify, just two. It's in the statute. You either have a reduction in gross receipts, quarter over quarter compared to 2019, or you have a documented government shutdown order.
Documented. Not something you heard on Facebook.
Yeah, exactly. If you can find on the internet the release from the local government, state, or federal government, and the federal government didn't have any shutdowns, so that's pretty much. So if you don't have that documented government order that you had to shut down your business that applied to your business, your industry, et cetera, then and you don't have the reduction in gross receipts, you don't qualify. If somebody's telling you, well, hey, if you couldn't get your materials, I see this all the time. Oh, my materials were being shipped from China and China wasn't getting stuff out. It's like, that doesn't matter. That's not a U.S. government order. That's issues with China. The ARC doesn't cover that. The only possible case you have in that particular scenario is what port did it come into, and was it stuck at the port because the port shut down? And I got to tell you, most of our ports didn't shut down. Matter of fact, in New York and New Jersey, the Port Authority saw record increases in productivity during the pandemic. They published this. The ports in California are a little different story. They actually did shut down. So if your materials are coming in through there, there's a possibility. But again, it all boils down to if you cannot find or your provider cannot produce a government order that says that your supplier had to shut down or your supplier can't do it or you had to shut down, then you probably don't qualify. And when the IRS starts to go after these, and they will, then they're going to come hard.
Right.
They've said so.
Yeah. So here in Harris County and Fort Bend County, county judges' orders.
Yes.
They would, and that's all published information.
Exactly.
Yeah. So don't get cute.
Precisely.
Yeah.
I've heard of arguments about how, well, hey, CDC this and OSHA regulations that. Nope. None of those are a government order.
Right.
None of those places can shut you down. It has to come from the municipality or the state or the federal government.
Yeah. So let's take this forward now. So business has documented everything for meeting qualification purposes. You vetted it and you're saying, okay, here's the tax credit that's applied. And they take the CPAs on board. They've looked at it and they file for taxes. And then you mentioned if there's an audit, you'll jump in on the defense.
Yeah.
So typically audits, about 18 months to 2 years after, typically well, now that we got 87,000 new IRS agents, it might be a little faster.
Well, that's going to take a decade to ramp up,
right?
But still, I'm knock on wood, that's going to be a good thing,
right?
Because and I don't mean to cut you off, but yeah. I hear people complaining in horror stories or whatever. Look, the IRS is moving so slowly. They were moving slowly before the pandemic, and they had to shut down for a couple of months. And that just backed things up even more. Right. I still have clients that are waiting on something from the IRS from a year ago.
Yeah.
It's insane.
Yeah.
Like, it shouldn't take this long.
Well, I'll tell you, as a professional, as a tax professional, we want an efficient system. And, we want to get rid of the bad actors in the industry.
Yeah.
Right? It's like the kid that pees in the pool and messes it up for everybody else. And so the more professionals we have in our industry, the better. That's my stance on it, right? Yeah. And so getting back to the credit being taken, and now there's a question that arises from the IRS. Okay, they come back and they say, hey, you took this credit here, and we think, or they could say, show us, or we think this is off, or however they want to phrase it. And now the process begins of justifying the credits that were taken, because if the IRS comes back and says, well, disallowed, now we got to go back, pay the interest, potentially penalties. So what does that process look like? How do you get involved at that point? So client comes to you, CPA's on board, and they take the credit, and now it's 2 years down the line, and they get a letter from the IRS.
So I've not seen this particular process play out on the ERC side yet.
Too early.
I'll answer that on the R&D side,
yeah.
But just real quick, what we are seeing the IRS doing right now for ERC is if it's a 2020 claim and it's below $100,000 per quarter, they're paying it out. But of course, even if that's the case, your 2021 stuff is going to be higher because the amounts are higher in 21. What we're seeing is your 2020 amounts will likely get paid within 3 months or so, 6 to 8 weeks. So about 1.5 to 2 months. Anything bigger than that $100,000 in refunds, they're not paying yet. And I'm assuming they're waiting for all these folks to come in and get trained up so they can vet these, because that's a bigger amount of money, and they're holding on to it.
This is on the ERC side.
This is on the ERC side.
Okay.
So we're seeing that the smaller dollar claims are getting paid, but the 2021 stuff that's going to be bigger it's sitting out there for now. And so there's a lot of assumptions, because we don't know what's going to happen yet. But what I surmise is going to happen is there's not really any gray area with this. There may be arguments of law and interpretation of the guidance, but the qualification parameters are set. There's 2 ways to qualify. We talked about it. And they're just going to ask, show me your gross receipts data. You don't qualify for that. Show me your government order. It's not there. You don't get this money. Matter of fact, if the same is true for your 2020 stuff that we paid, now you got to pay that back with, as you mentioned, the penalties and interest. So we need to be very careful with how we're going after ERC.
Right.
It's looking to be more and more of a minefield.
Yeah. Okay, so let's get back to the R&D.
Yeah, on the R&D side. So what happens if you're examined for an R&D credit claim? So there's 2 different types of claims, especially now. There's your claim in a current year, and it goes on your originally filed return, and your likelihood of exam is incredibly small. It's basically just the same as filing your return without it. It's the audit lottery, whatever. On an amended return, it's still unlikely to be examined because of how strained the IRS has been and whatever. They just don't have the resources to go after all these things. But they will send a notice that they want to look at it. They want to talk about what this claim came from or whatever. And then they'll send their information document request, and they'll go through that process, and you'll answer their questions. And hopefully everything goes well if you've claimed this credit. And if not, you have to go through appeals. And if you go through appeals and that doesn't go well, then your only option is to file suit against the IRS, which most companies that I work with are not big enough to do that. It's whatever. So what we see in the information document request in the actual exam steps are they want to know that what they worry about the most, and they've published this. Like,
right.
We don't like when you're basing your claims on high-level estimates. We don't like a lack of nexus between the work people are doing and the actual credits. We don't like having officers like the C-suite allocated at high percentages, even in small companies. So
what does that mean?
So, like, if the CEO of a 5-person company, they likely are paying themselves a good amount of money.
Right.
And so what people have done is said, okay, you got your 4 people at this company that are making like $50,000 a year, and they may be contributing a little bit, but hey, CEO, you're making, $200,000 a year. If we can get most of your wages in the pool for calculating the credit, it's going to go up. So how much time do you spend, actually doing R&D? And a CEO, their job is not to do R&D
right.
in most cases. Sometimes it can happen, but in most companies, it's not the case. But there's a rule that if you're directly supervising R&D, you can also claim your time, or directly supporting it. The thing is, if you can't document as a CEO that you're directly supervising the R&D activities, then you're not directly supervising
right.
the R&D activities, and it's just they want to see that. And you're allocating of 100% or even 50% of that CEO's wages. They don't want to see that unless it's pretty obvious and
right.
you've documented that. Yeah, they're spending a lot of time on the R&D, and somebody else is actually running the business.
Right.
And so
that makes sense.
Yeah. So yeah, they go through that. They'll ask questions. If you've misapplied the law, then shame on you, and you'll take a hit for that. But if it's questions of fact, then you do what you can. We do what we can to show, okay, here's the evidence, here's the documentation, here's what we put together, summarizing everything, and typically it goes pretty well. There are instances where we had a state of Texas exam, and it didn't go well only because the state back in October. So we delivered numbers back in 2019, 2020. In October of 21, the state of Texas changed what qualifies, what expenditures could qualify, and made it retroactive to 2011, I believe. So it goes to exam this year, And we're like, what do you want us to say?
Yeah.
Like, we were going off of the law at the time. You changed it, made it retroactive, and it was a small dollar amount, and the client was just like, don't worry about it. So we just walked away. It didn't make any sense.
Yeah, and when you're talking about state of Texas, most small businesses are exempt.
Well, yeah. If your business doesn't have at least $1 million in gross receipts, that's a million and change, then you don't have any Texas franchise tax to begin with. And the Texas franchise R&D credit only offsets 50% of your tax liability to begin with.
Yeah.
So unless you're a bigger company paying a lot of Texas franchise tax, it's not worth it.
Okay, so you mentioned the dollar amount, the company size, and you said not worth it. So let's talk about who this is for. Okay, and we mentioned startup companies, software companies that might qualify for the payroll side on the smaller startups. So what is the size of the company, whether it's revenue size or EBITDA, I mean, however you want to define it, that they should be looking at this as, for the work they're doing, there's a tax credit out there, right? You should be looking at it. So what does that look like?
So our firm is a little different than most other firms because we don't turn folks away just because it's small. We give you the information. If it's too small for you to want to deal with the amount of work it's going to be put into it, then you can say, nah, it's not worth it. But we give everybody the time of day because we want to help, especially small businesses and startups. So any software developer that's got $1 million in gross receipts is going to have a good credit.
Gross receipts.
So sales.
Revenue.
Revenue. Yeah. So we'll talk in terms of revenue.
Yeah, okay.
I say gross receipts. That's what's listed on the tax return.
Yeah.
Whatever. So yeah, if the revenue is $1 million or more, it's a good deal. And if it's half that, it's still maybe beneficial for you. It may be worthwhile. But if it's $1 million or more in revenue, your software company is likely going to claim a pretty good credit. It's going to save you a lot of money. Manufacturers, it needs to go up a bit. If you're looking, 10 million or more, it's likely good dollars for you. If it's less than that, you're likely not paying a ton of tax depending upon what your raw material costs are, what your labor costs are. So again, if it's 10 million or more on the manufacturing side in revenue, then you should definitely look into it. Architects and engineers are more like the software side because again, if you're not paying for raw materials, then your costs are going to be lower and your margins are higher. So architects and engineers, $1 million or more, probably going to look very good for you. And I'm talking in terms of the size of the credit and the impact it's going to have on your taxes.
Right.
So anything smaller than those, your tax situation, even if you generated a pretty hefty credit because of the facts and circumstances, it's not going to do as much good for you. Because if you're not paying a lot of tax, you're just accruing these carry forward credits that you're going to use in some future time. Me personally, and our firm, the mantra is, look, if we can generate you a bunch of credits, but you can't use them for 5 years, then you shouldn't do it right now. It's like, why pay for something now that you don't know when you're actually going to use? Let's just keep an eye on it.
Yeah. Now, I know in the Inflation Reduction Act, a lot of the credits that they were talking about are things that you could buy and sell, right? Mm-hmm. Is the R&D credit like that? Or is it just unique to the person applying it?
So so the R&D tax credit and the employee retention credit are non-transferable, so you can't sell those. It is good that, especially because, especially in energy, it's sort of like feast and famine sometimes. So generating all these credits and being able to sell them is good for the bottom line. So the answer to your question is, yeah, it's like the R&D and ERC credits, they're non-transferable. On the state side, though, if you're qualified for a federal R&D credit, you probably qualify for your state credit. About 30 plus 35, 38 states have an R&D credit too. Some of those are transferable. I think Pennsylvania's is. There are some other ones. So if you qualify for federal and you've not looked at the state credit for whatever reason, then it may behoove you to look at your state credit to see, even if you're not able to monetize it, use it to offset taxes in your state, you may be able to sell it and get some extra income.
Interesting.
Okay, so how would someone go about selling their credit? Is it just a matter of, is there like a source or a place you go to where there's buyers and sellers?
Yeah, so there's typically a state-sponsored marketplace.
Okay.
So in Pennsylvania especially, they're actually moving their system. I don't want to get too far into the weeds here, but basically there should be a marketplace for it. And if not, it's a question of documentation, making sure that you're doing everything above board according to the statute. again, you have to be careful. There are bad actors everywhere, and everybody wants to save money on taxes. Not everybody wants to do it legally.
Right.
Pennsylvania's system now has a much more strenuous process, sort of like what the IRS is doing now, because somebody came in and they said that they claimed all these Pennsylvania R&D tax credits and then sold them, and they didn't actually have any R&D. Like, people are scamming everything everywhere. You got to be vigilant.
So you would need someone like you or someone who's specialized to actually diligence the credits, make sure they're okay, and then before you even enter into a transaction.
Yes, and that's especially important. Like, the states are kind of moving the goalpost a bit, and it makes sense. As states need more money, they want to stop sending money out the back through whatever credits and incentives. I don't love that it hurts small businesses, but I get it from a politics and budgeting perspective. The IRS is kind of doing something similar, and again, they put measures in place starting in actually effective this year, January, where if you're filing an amended tax return for the R&D credit, you're filing an amended return for a refund claim because of the R&D tax credit, it's not sufficient to just file your amended return. You have to include there's 5 items of documentation you have to include with it. More work for us, more work for the taxpayers, but I get it. And it's something that, again, we were already doing, but hey, we got to do it up front now. Typically, we do a bunch of diligence, we take a bunch of notes, we calculate your credits, we get it to you because it's all deadline driven. And then we put together all of our reporting after the fact. Now, we can't wait to do the reporting after the fact. It's all got to be done when your tax return gets filed. Starting next year, we're going to see changes to the form that you use to file the R&D tax credit, the 6765. And there's going to be additional items. It's more than 5. I think it's like a dozen additional things that they want to start seeing when you file for the R&D tax credit, which again is very onerous for taxpayers. And it's good for job security for me, but again, that speaks to the fact that if you're looking to go after these R&D tax credits or the employee retention credit, talk to somebody you trust, go to your CPA, have your CPA find somebody that they've talked to, that they've vetted, and go after it through those channels, because doing it on your own is dangerous.
Yeah. So we are. Well, it's almost December right now, and so I think this is our last podcast for the year.
Yeah, probably.
And then we're gonna hit the holidays. But come January, tax planning picks up one more time. Right now, we're into making sure we're ready for compliance, but finishing up the year. But next year, here we go again. So when is the best time? Is there a best time of the year for these companies looking at R&D credit as part of their planning process? Yeah.
So honestly, given the amount of things that we need to do in order for you to file, the best time to start is now. Even if it's just to get your estimates of what the tax credits could be for your tax planning discussions, the more information that your R&D team, that we can get from you now, the better. Because it's going to take us a significant amount of lead time to get everything wrapped up and done the way that the IRS wants to see it.
So what are we talking about? 6 months lead time, 9 months, a year, 2 years?
3 to 4.
3 to 4
months.
3 to 4 months.
Yeah.
So whatever, even if we start now in December of 2022, we're really looking at 2023.
Yeah, I spoke at a CPA CPE conference in Austin a couple of weeks ago, and I was telling them, I was like, look, if your clients want to go after this, we need to know now. If we keep waiting, we're not going to have time to get this done, and I'm not going to rush to get it done half-assed. It's got to be done right.
You can't say that on TV.
You might be the first person to curse on our podcast.
We're gonna have to bleep it out. We're gonna have to bleep it out.
We're just busting your chops.
No, so it's important that this gets done right and done right the first time, because you don't want to have an exam come up to where you've put half the information together and you're left holding the bag. Like, the IRS wants to know that you did the diligence up front.
Yeah.
And so the more lead time we have to be able to start looking at this, at least start the conversation now to see if it's even relevant or worthwhile to you.
Yeah. Well, I think the theme moving forward is going to be make sure you document everything, because inspections are going to go up.
Yeah.
Examinations are going to go up, and document, make sure it's applied correct way. And, if you're unsure, don't do it. Right. And talk to trusted advisors, folks that do this business, attorneys, whatever you need to do, make sure that it's done on the up and up.
Yeah.
100%.
Information contained in this podcast and accompanying video have been derived from sources believed to be reliable. This content is not guaranteed as to its accuracy and does not purport to be a complete analysis of the topics discussed. Analysis is based on assumptions that may not come to pass. None of the content should be construed as legal or investment advice. You should consult with a qualified professional before implementing any strategies discussed. All expressions of opinion reflect the judgment of the speakers on the date the video was recorded and are subject to change.